This is Sharon Garvin of Wayne State College. This is my screencast for Chapter 19 of the Accounting 2 online course. Several topics covered in Chapter 19, one of which is a standard costing system. This picks up on the budgeting chapter that we covered, Chapter 18, in that we're actually setting a budget per unit now to further isolate where the problems are. Back in Chapter 18, we could take a budget figure, compare it to actual, and see if there's a problem, but not really be able to identify the cause of that problem. Under a standard costing system, we take the budget variance, the flexible budget variance, flexible budget versus actual costing, and divide it into a price component and a quantity component. So when we teach standard costing on campus, we use the three-column approach. It seems to be popular with the students. They seem to like it. And this is an example problem I use in my household. Let's assume I have a budget where I can buy 1 gallon per week per person in my house. This is when my kids were growing up. We were going through a lot of milk, assuming milk is $4 a gallon. So when there were my husband and I and our 2 kids, basically I had a $16 per week budget on milk. My son drinks a lot of milk when he comes home from college, so when he gets home, we go through a lot of milk there. So let's assume last week I spent $21 on milk. I'm supposed to spend $16, so there's a $5 unfavorable variance there, and you would think that me being the grocery procurement officer for my family that I would be disciplined for going over budget on that. But by using standard costing, we could use this three-column approach here and figure out or better explain where the $5 discrepancy came from. Under the three-column approach, in the first column we go actual times actual quantity of the milk, number of gallons of milk that I purchased times the actual price. In the middle column, I use that same actual quantity from column number 1, but this time I multiply it by the standard price. That's the budget price per gallon. And over here on the third column, it's standard quantity allowed based on the good output times the standard price. So when students here on campus do the third column, they always have to do a little side computation and ask themselves, how many units did we actually make? Therefore, how many gallons or pounds or feet of materials should we have used? In this example problem, it's how many people are in the house. So if there's 4 people in the house, and each one is allowed 1 gallon per person, the standard quantity allowed based on the number of people in the house would be 4. Times the $4 standard price is 16. So the difference between columns 1 and 2 is called the price variance, and that's a $3 favorable amount. The difference between columns 2 and 3 is the quantity or usage variance. That's an $8 unfavorable amount. So in purchasing circles, the purchasing department is responsible for the price variance. They actually did a pretty good job getting the milk at $3.50 a gallon instead of the usual $4, so that was good. But the production management people, the people actually using the raw materials, or in this case, the person drinking all the milk, which turned out to be my son, would be disciplined for the quantity or usage variance. It wasn't so much that I spent so much on milk on a per gallon basis. The problem was we went through 6 gallons of milk instead of the expected 4. So it was a quantity problem, and that's responsibility of production management. So the standard costing system allows us to take a flexible budget variance, that is the difference between actual, column 1, and the flexible budget amount, column 3, and divide it into price and quantity components. In Accounting 2 on campus, we also talk about the different types of centers and how you would do performance evaluation for each. So for example, if you're in sales and all you're responsible for is bringing in revenue, you might have a budget of costs, but that really isn't the main thing that we evaluate you on an annual basis. We would, to evaluate you as a revenue center where you're basically in charge of bringing in sales and revenues, we would calculate a sales price variance and a sales volume variance as follows. So the difference between the three-column approach here would be, again, it's still actual times actual, actual times standard, standard times standard. The actual quantity would be the actual number of items you actually sold at what the specific price was. The actual quantity times what we expected to be able to sell the items for, and the number of items we expected to sell when we set up our master budget at the beginning of the period times what we thought we would sell them for. So the difference between columns 1 and 2 is a variance. That would be the sales price variance. And that would be a function of, did we sell the units for the price that we anticipated? There might be a good reason why we had to raise prices or drop prices, but this would isolate the dollar amount of the variance based on the fact that we charged a price different than what we expected. Difference between columns 2 and 3 would be the sales volume variance. Again, why did we sell a higher quantity or a lower quantity than what we expected? Might again be a perfectly good reason for that, but we want to investigate that and possibly adjust our strategy in the future. If instead of being a revenue center, you're a cost center, that is, you're not in charge of bringing in sales or revenues, your job as a manager is to keep your costs down, we would use something close to what we learned about in the standard costing system. So we would take our particular part of the business and try to isolate the fact that our budget was higher or lower than what we anticipated because the prices of the items that we were purchasing or consuming were higher than what we thought. Versus the quantity of items we were using in our particular department or sub part of the business were higher or lower than what we thought, and try to explain those, maybe make adjustments so we don't have unfavorable situations happening in the future. The third thing, if you're in charge of a profit center, that means the manager is in charge of bringing in sales and also keeping costs down, but they do not have investment responsibilities. So a good example of this would be someone who's in charge of a department of a store. They don't get to make decisions based on whether the building should be remodeled or any major decisions associated with high dollar amount investments in property, plant, and equipment and other resources and assets, but they are given part of the store that they're responsible for, so they're supposed to bring in the sales and try to keep their costs down. We would do what we call a segment margin income statement. You're familiar with the contribution margin income statement already. That's sales minus anything that's variable, whether it's a product cost or period expense, doesn't matter. Just as long as it's variable, we'll subtract it out. Take a subtotal and call it contribution margin. Then we look at our fixed costs and say, some of them the manager really does have some ability to control, and some they don't. So there are specific things that we can trace to a manager's control. We would go ahead and subtract those controllable fixed costs out, take another subtotal, which is called segment margin, and we would use that to help evaluate the performance of the profit center. Is it covering all of its variable costs and expenses and contributing toward the payment of fixed costs that are going to be there anyway and thereafter help generate a profit? That's good. The second item we'd look at, is it generating a positive segment margin? That is, it's not only covering its variable costs and expenses, but those fixed costs that the particular manager or subunit of the business actually has some control over. Is it able to pay for those as well? And if it is, and that's a positive number, we would want to keep that particular business segment. So we had taught you before that if a company had a positive contribution margin, that segment should be kept. If it had a negative contribution margin, that should be discontinued. We need to kind of expand that now and put in our decision criteria about performance evaluation for the subunit, what the effect of a positive or negative segment margin has on that. If the company business subunit has a positive contribution margin as well as a positive segment margin, you should keep that segment. If the segment has a negative contribution margin and a negative segment margin, then the manager should be reassigned or moved somewhere else in the business where they might be more productive. You cannot have a situation where you have a negative contribution margin and a positive segment margin. Segment margin is always going to be smaller than the contribution margin. So that is an impossibility. But you can have a situation where you have a positive contribution margin and a negative segment margin. That is, the subunit can take care of all of its variable costs and expenses, but is not big enough to pay for the directly controllable fixed expenses. So then in that case, we should do one of these three things. So for example, if you're running a department store and the shoe store is not doing very well, it has a positive contribution margin, but it has a negative segment margin, you might have to get creative with your shoe department and find out if there are some new strategies maybe we could try, or some new styles of shoes, or some new advertising or marketing or sales techniques that we could use to better serve our customers, and get a little bit creative with that to make our shoe department a little bit more profitable. Or we could take the segment resources for the shoe department and give it to some other department. Let's say our housewares department is doing very, very well, So we could give more square feet of the store to the housewares department and kind of cut down on the number of square feet we allocate to this underperforming shoe department. And they might be able to pay their smaller amount of costs that they're responsible for then. Or you could look for a whole new segment in your department store that we could add that we don't have now to replace this underperforming one. And again, bring the overall performance of the store as a whole up higher. If you have an investment center, the manager in charge of an investment center is not only responsible for bringing in sales or revenues, not only responsible for keeping costs down, but they're also responsible for making resource decisions, investment decisions, big ticket items like property, plant, and equipment types of decisions. So we hold them responsible for the type of return that they're making on the asset resources that they have been given responsibility over. The DuPont people used to look at the return on investment ratio, which is return on assets, net income divided by assets. And if that was a relatively low number, they knew they had a problem, but it didn't really tell them anything about how to fix it. So what the DuPont people did was they took the mathematical computation for return on assets and subdivided it into these two ratios, asset turnover and net profit margin ratio. That is, they took net income divided by sales times sales divided by total assets to divvy up their return on investment. And you can see from a math standpoint, the sales are going to kind of cancel each other out. So you're thinking, okay, why are we going to all this work to do this? It's because if we can better isolate where the problem is, let's say our return on investment is low compared to an industry average. Our asset turnover looks pretty good compared to the industry average, but our net profit margin ratio is lousy compared to an industry average. We've basically isolated our problem to be here. And if you have a low net profit margin ratio under the DuPont method, there are two very specific things we can do to improve our performance. So this helps us determine the proper strategy to take. We can do one of two things. We can either try to increase our sales prices, or we can try to cut down on our costs. And I ask the students, which should we do first? And generally, we should try to cut down on our costs by using those types of things we learned about in activity-based management, that is, reduce the number of activities or reduce the cost of performing the activities, which means we'll be able to maintain the same sales that we had before, but because we have less costs, it's going to make us more profitable per dollar of sales, and that will help with our net profit margin ratio problem. The difficulty is if you go with the raise sales prices option, sometimes you do scare off some of your customers, you hurt your sales volume, and then you're going to have problems over here in asset turnover. So of the two strategies, if net profit margin ratio is your problem area, cut costs or increase your selling price. Cut costs should probably be your first line of defense. If your return on investment is lousy, your net profit margin ratio compared to the industry average is just fine, but your problem seems to be here in asset turnover ratio. It's a volume kind of a problem. We need to be selling more items. So there are two strategies, again, if you find yourself in this situation. One is try to increase your sales volume, or the other one is downsize the company. That is, try to become a leaner, smaller company, maintain the same sales that you had, but using fewer resources because you've sold off or closed a number of stores or factories or plants. So of the two strategies you can use, if asset turnover ratio is your problem, you'd want to go with the increased sales first and turn your marketing people loose and tell them to get a little bit more aggressive and try to get those sales volumes up. Downsizing might have to happen like it did in the Great Recession here we've had in the last few years, but that's kind of a later resort. You don't want to do that right away. You're laying off people, you're closing plants and stores. It'd be really tough to sometimes bring those people back or reopen those factories and stores. So DuPont people gives us some very specific strategies we can use to better improve our business situation if we can isolate where the real problem is. Finally, the last thing I want to talk about when evaluating an investment center, you can use residual income. Residual income basically takes the income of the subunit and it subtracts out a target rate of return, usually the cost of capital for the company, times their total assets. Here's the thing, a lot of times when we look at business situations, we see on the income statement we've subtracted out interest, but we've never taken anything out for the cost of capital associated with equity. So what this method is trying to do, it's trying to take our total assets and dividing by our overall cost of capital, both debt and equity charges, and see if the subunit is generating enough income to pay for both the requirements for debt financing and stockholder financing, and have something in addition to show for that. So a positive number in residual income means you should keep the segment. Negative might mean you need to change some strategy or maybe get rid of the business subunit. This is the end of my Chapter 19 screencast.